What's going on? Alex here, and today we're going to have a showdown between self-employment and the S corporation. And we're going to answer the question, are S corporations worth it? So why is this important? It's important because so many business websites out there, they say that the first thing that you have to do as a business owner is get an LLC and make the S corporation election. And unfortunately, we see that in many cases, business owners make the S election way too early. So instead of saving money on taxes, they actually end up spending a lot more in administrative costs like payroll, accounting, tax preparation, and all those other costs that come into play. And even if they save, let's say, X amount in taxes, if they exceed that amount in all those additional costs, they actually end up behind where they would be. So we've seen this happen way too many times. And today we're going to look at the comparison between being self-employed and making the S corporation election, seeing if it's really giving you the bang for the buck. And we're going to look at it at different income levels. We're going to get pretty in-depth here. Now, a bit of background. Before the Tax Cuts and Jobs Act, which was enacted essentially in tax year 2018, it used to be a no-brainer in that if you were a higher income self-employed individual, that you make the S election and save a bunch in taxes, especially Social Security and Medicare taxes. But since the Tax Cuts and Jobs Act was enacted, it had several provisions, including the qualified business income deduction or the QBID, and several other provisions that really changed the dynamics between being self-employed and having the S corporation election in place. And you may be surprised at how some of the numbers actually play out once you put projections together. So that's why we're taking a look at this today, because this is one of the most common questions that we get in our tax practice, and it can really save you thousands of dollars from a tax filing and from a tax perspective overall if you make the right decision at the right time for your business. All right, so with that, we're going to take a look at the scenario here. And you can see we put a handy dandy spreadsheet together as usual. You know how we do it here. And every good set of projections has a good set of assumptions to go along with it. And this scenario is no different, all right? Now, some of the assumptions that we're taking into account are, one, that the qualified business income deduction or QBID is applicable. And for the vast majority of businesses out there that want to potentially be an S corporation, the qualified business income deduction would be applicable, same on the self-employment side. So it's a safe bet that it would be applicable in more situations than not. So that's why we're assuming that it does apply. Then we're also assuming that the business is a specified service, trade, or business. Now, this is an important point. And the term specified service, trade, or business, or SSTB, came about with the Tax Cuts and Jobs Act that I mentioned earlier. And if we look at this IRS FAQ, it's a frequently asked questions document here, we could see that it defines what an SSTB actually is. And it says here that for taxpayers with taxable income that exceeds the threshold amount, specified service, trades, or businesses, SSTBs, involve the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, and you can see the list over here. It's fairly comprehensive. So most of the businesses that want to consider making the S corporation election, they would fall under one of those categories. And if so, we have to take them into account as a specified service, trade, or business, which affects the amount of the qualified business income deduction or QBID that they're allowed in many cases. So we do take that into account in this situation, and on both sides, both the S corporation and the self-employed side, we're going to assume that the businesses are specified service, trades, or businesses. All right. Next, on the S corporation side, as you may already know, one of the biggest levers that you can pull has to do with the amount of salary that you take out of the S corporation versus the amount of distributions that you take out. And that dynamic is really going to influence the amount of taxes you pay at the end of the day. And the question is always, well, Alex, what should my reasonable compensation be? And unfortunately, the IRS and the tax code did not provide any bright line analysis that says, hey, if you're a doctor, this is your reasonable comp, or if you're an architect, here's your reasonable comp. We have to look at the facts and circumstances and assess in every situation what the reasonable comp should be. I've made a few videos regarding S corporations, so check them out on the channel if you're interested. I'm not going to go too in depth here. But to sum it up, we're basically going to assume that this is an S corporation with a single shareholder / employee, and the allocation of reasonable compensation compared to distributions is 45% versus 55%. Now, where do I get these numbers? Quite simply, it's from the Watson case from the United States 8th Circuit Court of Appeals. And if you're interested, you could read that case. We're not going to go too in depth here. We want to keep this relatively simple, but you can pause the video here if you're interested to see how that allocation comes to play. It's basically the 45% amount that we took straight out of the Watson case. But I want to make very clear, this is not a recommendation as far as what you should do with your S corporation. We're not saying take 45% or 55%. With reasonable compensation, percentages have nothing to do with what your reasonable comp should be. For purposes of the projection, we're using that number to be as generous as we can towards the S corps. But I'm telling you guys, don't take this 45-55 and apply it to your situation. I know I'm going to get emails saying, hey, Alex, I took your recommendations and they worked out great. No. It's not a recommendation. I can't make that any clearer. And this 45%, we're going to apply to our scenario. So basically, after the other expenses are taken into account, we have the net income before the shareholder pays themselves. We're essentially going to have 45% of that come out as reasonable comp or wages, and 55% come out as distributions. And you'll see how those numbers play out a bit more. The point I want to emphasize is that by taking the 45% amount from the Watson case, I'm being about as generous as you could possibly be toward the S-Corp side. I didn't want people to say, hey, Alex, you're biased, you're pushing up the reasonable comp too high. Why is it 60% or 70% or 80% of the overall income that comes out of the S-Corp? That's why I'm trying to be as generous as I can toward the S-Corps, 45% versus 55%. It is what it is, not a recommendation for your situation. All right, now that we're past that, number 4, no retirement plan contributions. Obviously, retirement plan contributions can skew the numbers one way or the other, and they work a little bit differently for the self-employment versus the S-Corp side. Not all that much, but to keep this relatively straightforward, we're going to assume that there are no retirement plan contributions either way, just to streamline the numbers and make sure we're lasering in on what we want to focus on. All right, now, there are some administrative expenses that go along with making the S corporation election, which do not apply to the self-employment side. Now, being self-employed may increase your tax preparation fees, it may increase your accounting and bookkeeping fees and so forth, but these are essentials for an S corp. And if you don't have any of those happening, that the items on this list, you may be in a precarious situation with your S corp. But let's just review them a little bit here, and we'll see that the first one is payroll service, all right? We're going to assume $50 monthly. Your costs may vary. Again, as I'm going through this table, if you guys say, oh, I can get this for cheaper, or these are the prices where I live, beautiful. Apply those costs to this analysis, and you'll be able to gauge the numbers a bit better for your scenario. So payroll service, $600. That's just 12 times 50. Then we have accounting and bookkeeping services. It's always important to have clean books, but it's even more important when you have the S corporation election in place. All right. So we're going to assume accounting / bookkeeping service, $300 a month. That's $3,600. Again, apply your costs if they're different. The preparation of the S corporation Form 1120S income tax return. That's going to be an annual fee that comes into play. Let's say $1,500. And the preparation of estimated income tax projections. So when you have the S corp, you're going to have the flow-through income, which is not going to be subject to withholding. So you're going to, in many cases, need to make estimated payments throughout the year at the personal level to avoid the assessment of penalties and interest. So for that, we just entered a price here of $1,500 because those can get pretty involved. And if we add all these costs together, we can get $7,200. Now, in your area, all of these costs, it might cost $3,000, so use $3,000. Or if you live in, let's say, San Francisco, it might easily be over $10,000, so factor that in. But these are the assumptions that we're using here in our analysis. And now we're going to jump straight into the numbers and look at scenario 1, which is self-employment and S corporation comparison. We're going to start with Schedule C and the net Schedule C income of $200,000. So in both of these scenarios that we're going to look at, this yellow area and the blue area, they assume net income prior to owner compensation of $200,000. We're also going to look at $500,000 and $800,000 and see the differences in the tax. But we're going to start with $200,000. And right here we have the scenario in the tax software all ready to go for you guys because you know how I do it. And so far, if you guys are liking this content, it's interesting for you, feel free to smash that like button, all right? Now, if we look at the tax return, we see that there's not much going on here. Single filing status, 2022. We have the standard deduction. Everything's pretty straightforward here. But what we notice is that on Schedule C, we have $200,000. All right. And there are no additional expenses. So the net income from Schedule C, $200,000, it's flowing through to the 1040. Everything is pretty much good to go. And we're seeing here that the total tax is $52,231. So let's take a note of that there. All right. And we also want to keep track of the qualified business income deduction, or the QBID. All right. That's going to be important as we go through this analysis, because it's going to change pretty significantly as the income goes up. Because remember, we're looking at this as a specified service, trade, or business scenario. Now, the QBID is going to be $30,209. So that is a deduction that is afforded based on the Tax Cuts and Jobs Act. It was relatively new. So these are the numbers we have for self-employment. Let's take a look at the S-Corp scenario. So similar to the yellow area here, we have S-Corporation net income prior to shareholder compensation of $200,000. Now, we're going to assume reasonable compensation is this 45% amount. All right, should look familiar. We just discussed where that comes from. Again, we're being as generous as we possibly can to the S-Corps, guys. So don't say that I've skewed one way or the other. And we have a reasonable comp of $90,000. We have S-Corporation shareholder distributions of $110,000. And they add up to the 200. So we're basically clearing out the income for the most part. And as an employer on the S-Corp side, when you take wages, you're paying the employer portion of those payroll taxes, being the Social Security and the Medicare. There are also sometimes some unemployment taxes that go along with that on the employer side. But here, just at the federal level, we're going to keep it simple. This is going to be the 6.2% on the Social Security side and the 1.45% on the Medicare side. And that's all based on the $90,000 in reasonable comp. Both of those together is $68.85. We want to factor that into the total tax situation that we're going to also get from the 1040, because at the end of the day, these are taxes that you're paying. All right. So once all that is said and done, the net S-Corporation flow-through income is going to be $103,115. How do we get that? It's the $200,000 minus the $90,000 reasonable comp or wages or salary, whatever you want. And then the employer portion of the payroll taxes is $68.85. All those combined get to $103,115. All right, so let's open up the tax software and let's take a look at how this plays out. All right, so here we don't have Schedule C. Again, we're looking at this from the K1 perspective. So if we look at the K1 from the S-Corp, you'll see that it is showing that there's $103,115 coming through. And we also have some distributions here, all right, of $110,000. We also have the wages coming in of the $90,000. All right, so everything that we talked about is being reflected. Let's take a look at the 1040. All right, so here we have $90,000 in wages, which agrees to this. Very nice. And as we're going through, one thing we want to notice is that the qualified business income deduction now is $16,451. All right, so let's remember that in the prior scenario it was $30,209. Now, in a very similar income scenario, it's dropped by almost $15,000, which is not insignificant. All right, so that's something we want to monitor. But let's take a look at the total tax on the Form 1040. This is the personal return. All right, and you'll see here that the total tax is $33,127. All right, now if we add the employer portion of payroll taxes to this $33,127, we get $46,897. So these are the total employee and employer taxes that you're paying at the federal level under the S-Corporation scenario. And how does that compare? Well, if we remember, the $52,231 was the total federal tax liability under the self-employment side. Here, it's only $46,897, which is a savings of $5,334. Now you might be saying, well, great, we just saved over $5,000 with the S-Corp election. This is fantastic. But let's go back up here and remember our costs, all right? Now, the idea is that when everything is taken into account, that you're able to save on the administrative costs and the taxes altogether. But in this scenario, if we assume that these admin costs are applicable, then you're actually falling behind. All right, you're actually paying a little bit more when you factor in the taxes and the costs. If these costs are lower for you, again, adjust this number and apply it to this analysis and see how it may play out differently. But those are the real costs and the pros and cons of putting this S-Corp together. At the end of the day, you have to factor in all of these different amounts that come into the picture. All right, so that's the first income level. Next, we're going to look at the same sort of comparison, but we're going to up the compensation to $500,000. And what do you guys think is going to happen there? So on the self-employment side with Schedule C, we're going to take a look at that. All right, everything else is being kept the same, and we don't want to change too much in these scenarios. So self-employment, we see that it's $500,000. We take a look at the 1040, $500,000. Now, let's take a look at that QBID. The QBI deduction went away. Why? Because the income is sufficiently high that the specified service, trade, or business designation comes into play, and it starts to reduce or even eliminate your QBI deduction. So in this case, you get no deduction, and the income only went up $300,000 from the last scenario. So let's take a note of that. All right. Then we want to take a look at the total tax, and we can see that it's $172,662. All right. All right. So now let's take a look at the same amount of compensation prior to shareholder wages at the S-Corp level. All right. Now we're going to see here that we have a W-2 coming in, and that is for $225, right? Taken right from the scenario here, we have some distributions. We have the employer portion of the payroll taxes, all that good stuff. And we see that the S corporation flow through income in this case is $262,623. And let's make sure that number is in the tax software. All right. And there it is. So $262,624. And let's take a look at the 1040. We see the wages of $225. Very good. Then as we're working through here, we want to note the QBI deduction is 0 again. All right. So we lost out on that. As the income went up, the QBI deduction went away because it's SSTB status that we're assuming. Now, for the total tax, we have $140,114. All right. And if we add together the employer and employee taxes, we get a total tax amount at the S-Corp and the personal level of $164,867. And when we compare that to the self-employment scenario at this amount of income, we essentially are saving with the S-Corp $7,795. Okay, but let's go back to those expenses. If these expenses are applicable, then you're just scraping by in terms of having an advantage on the S-Corp side, all right? So it's starting, we're past the break-even point, and we're starting to actually save when it comes to the administrative costs and the taxes. But let's assume that this S-Corp is in California. California has an entity-level tax of 1.5% of the flow-through net income amount. So in this case, it would be $262,623.50 times 1.5%. And for the wonderful pleasure of doing business in the state of California, you get to pay an additional $39.39 above all of these employer and employee taxes that we have here, which in addition to all of these administrative costs would actually still put you behind in the $500,000 compensation area. So imagine that. You went through all this work, you made these fancy elections, you have all this fancy stuff in play, and at the end of the day, you're shelling out more money than you would if you just kept it simple with a Schedule C. A lot of business owners are surprised with that dynamic when they find this out. All right, and it would look worse on the S-Corp side, don't forget, if we weren't as generous with this 45%, 55% allocation. In my opinion, in some situations, this may be extremely aggressive, this allocation, okay? So you have to have a reasonable comp analysis put into place to determine what percentage allocation is necessary for your situation. You can't just run with these numbers. I know I'm gonna get emails saying, oh, I did it, it worked out so well. No, don't take this as a recommendation. We're just putting projections together, all right? Okay, so final set of scenarios here. We're going to take a look at $800,000 of net income prior to owner compensation. All right. Now let's look at the self-employment side. And what do you guys think is going to happen here? Is this going to get better for the S-Corps or worse? Let's find out. All right, so here we have Schedule C income. This is going to be the full $800,000. All right, so let's apply it to the return. All right, we also notice that there's no QBI deduction, so we're kind of outside of the stratosphere as far as the QBI deduction goes. So no love for the high income earners on that side. All right, and then the total federal tax liability is $291,330. All right, now let's compare to the S-Corp. All right, so we have a scenario here. Look, I set this all up beforehand for you guys. Isn't that beautiful? So let's look at the wages. We have $360, which we're getting from here. We have some distributions there, all that good stuff. The net flow through from the S-Corp is going to be the $425, which we're going to see here. All right, $425,666. And with that, let's take a look at the 1040. So here we have $360,000, makes sense. All right, and then we have the flow through income from the Schedule E or the Schedule K1 of $425,666. Again, makes sense. No QBI deduction, so the income is too high for the QBID if you're SSTB. Now, the total federal tax liability is $250,300. All right. Okay, so when we compare the S-Corp scenario to the self-employment scenario, now we're saving $12,362. All right, now we're starting to cook a little bit, but also remember those additional costs can come into play from the administrative side. You can adjust these as necessary, but let's assume that this entity is in the wonderful state of California. What would it cost us to run this S-Corp in California? Well, we take the S-Corporation net income, so the $425,666 times 1.5%. And what do we get? $6,384. All right. So let's assume that that's what we're paying. And let's assume that these expenses come into play as well. $13,584. And if we look at the total tax savings, guys, are we ahead or are we behind? All right. We saved $12,362 in taxes, but we paid an additional $6,300 in S-Corporation tax at the California level. And then on top of that, we had those additional administrative expenses. We're still coming up behind. All right. And hopefully this alleviates some of the doubt around whether you should get an S-Corp or stay as a Schedule C business. It all comes down to really assessing your personal situation and maybe having some projections put together to ensure that you're actually saving money as opposed to spending more. I know a lot of the attorneys out there like to put together overly complex setups. A lot of the tax people out there also, you're guilty as well. They put together these super elaborate setups that make absolutely no sense because the costs become astronomical and the benefit to the client at the end of the day is questionable at best. All right. So I wanted to make the point here that the S corporation is not the end all be all. It's not what you should jump to as a new business owner. You can have a few years in business and then make the S election if and when it makes sense for you. You can do it year 2 or year 3, what have you. And when you start a business, you don't necessarily have to rush to open an LLC and then make all these fancy tax elections. And again, this is from a tax perspective. I'm not giving you any advice from a legal perspective. I'm not an attorney. I can't give legal advice. So if you're putting together an LLC for legal purposes, that's a totally separate matter. I can't help you. But if you want to take a look at the tax perspective, then that's where we can actually help get some projections put together, see if it makes sense. And when everything is said and done, see if you come out ahead or behind, as we illustrated in some of these scenarios. So if you're pulling your hair out trying to make a decision as to whether or not you should make the S corporation election, Efros Financial offers a full suite of services, financial planning, accounting, and taxes. So if you need help, give us a call and we can help you through all this craziness. And as usual, if this video was helpful for you, feel free to smash that like button, subscribe to the channel, hit that notification bell to be notified of future videos because there will be more, and leave some comments down below. I love reading your comments. If you ask an interesting question, I will make a video about it just like this one. And with that said, hopefully this was helpful. Thanks for watching. Hey, you know what, guys? I'm back. I just noticed that you guys have been dropping questions here, which thank you so much. I love your questions. And I'm going to go ahead and address some of them right now because I appreciate you guys watching. And hey, it's all about learning and sharing the knowledge, right? All right. So Lewis M asks, what do you think about single shareholder S-Corps with 0 employees where all revenue is generated based on the work of the sole shareholder? And should they take all compensation versus wages and distribution? So let's take a look at this. I love your question, guys. Keep them coming. And let's see here. What do you think about the single shareholder S-Corps with no employees? So I'm assuming there's going to be the 1 employee, right? Because otherwise, I'm not sure how that would come together. But let's say it's a single shareholder employee where all revenue is generated based on the work of the sole shareholder. Should they take all compensation via wages versus distributions? This is a contentious topic, all right? And unfortunately, we don't have a bright line answer on this from the IRS or any other taxing authorities. And what we have to rely on are some of the tax court cases or court of appeals cases that have been applicable in this area. And what I can tell you is that if indeed it was the case that all of the net income should be taken as wages by the S corporation shareholder, then nobody would make the S election. It just wouldn't make sense. There's really no tax savings there. And if you look at that Watson case, I recommend you read this. This is from the 8th Circuit Court of Appeals. It does get pretty in-depth in terms of how reasonable compensation should be calculated. And in that case, Watson was a single shareholder in his S-Corp. He was the only employee. So that scenario hits on the head the question that you just asked right there. So what I would say is read that case and see what conclusion you come to. At the end of the day, if you have clients, you have to advise them as professionally as you can. So you have to go with what you have and whatever's most authoritative. And these tax court cases and these court of appeals cases tend to be authoritative in this regard. So we would go with that. But I can't imagine a scenario where you would have 100% of the net income from the S-Corp being paid out as wages, because then the S election completely falls apart. There's really no reason to do it. If anything, it becomes a detriment, okay? So hopefully, Lewis, that answers the question. I appreciate you. And let's see here. We have Michael Barry. What do you have for me? All right. I just passed my 30A exam. Thanks for the great videos. Now, Michael, thank you for watching. I appreciate the comment. And congratulations, all right? That means you're in EA land. You're part of the club now, all right? Which means you're going to get all the women, all the money, all the Bentleys and Maseratis that you could possibly... No, I'm kidding. But still, congratulations. And I love that you've achieved the unachievable. Well, it's achievable. You just got to try hard. All right. We got another question here from Dennis. Quick question. They're all quick questions, aren't they? I love it. All right. So I want to combine the CFP designation with the EA designation. Is this a good combo? I'm from a school of thought that you can't have too much education, right? I don't think that you're ever going to encounter a scenario where somebody's going to say, oh, he's a CFP, but I don't want to work with him because he's also an EA. What is that, right? I want the people who I work with to have as many designations as possible. You know, when I see a doctor, I want to know that they're board certified, that they received a PhD on top of their MD. They're also a lawyer. You know, I want as much education as possible with the professionals I work with. And you can't go wrong by having too many designations. If you look at my name on my website, it has a bunch of alphabet soup after it. And I don't think anybody's ever said, well, I would have worked with him, but it's just that MBA that he has. I really don't like that. That's not for me. You know, so if you have it, flaunt it, combine as many of these as you can, especially when they make sense. You know, some people are out there going, I want to be a certified financial planner and a certified fraud analyst. I don't see how the two are connected. It seems like two completely different things. But when there's synergy and there's overlap between the areas and you can get more powerful on the CFP side by knowing the taxes back and forth with your EA designation, I say go for it multiple times, all right? If you could throw the CPA in there, even better, right? Because not too many people know what the CFP is. Not too many people know what the EA is. The EA people have done a terrible job of marketing that credential. But when you throw the CPA on top of all of this, it's like the cherry on top. I've had people just call me out of the blue and say, hey, Alex, here's my life story. What do you think? And they really have no reason to trust me aside from the credentials that I have. I don't know if they verified them. But hey, the CPA does get a lot of respect. CFP also gets respect, but it's not as well known. And EA, they need to do a better job. I'm an EA myself, but EAs are terrible with the marketing. Nobody knows what that is. Hopefully that helps. Dennis, appreciate the question here. All right, and let's see here. We have another question here. Keep them coming, guys. All right. This is a question from Lewis. I know you hang out from way back in the day. Thank you for sticking around the channel. I appreciate you. Now, what's a good way to get clients on the side while working on my firm? I want to escape the rat race. All right. Well, whenever someone asks me for career advice, I always go about it by mentioning that if you can eliminate the risk or reduce the risk, that's where you want to be. Now, quitting your job and then hoping to get clients isn't a best approach, because in some cases, if you've never been self-employed, if you've never had to sell yourself and market yourself, you may find that it's completely different than you expect. And it's not something where someone who hasn't done it before can just hit the ground running in many cases. Sometimes you got to take your knocks, take your hits, and learn from the school of hard knocks. And unfortunately, I've been there. So what I'm saying is, instead of quitting a full-time job and trying to do this full-time, maybe start taking on some clients on the side, all right? Maybe have a day during the week where you just work on your own clients and start to build that up. And on your third client, you may find that you absolutely hate working directly with clients, because now it's all on you. All of the procedures and processes and everything that goes along with being a business owner, both positive and negative, it's all on you. And you have no excuses in many cases, right? Because if something goes right, then great. If something goes wrong, it's all your fault. All right. So try to approach this in a risk reduced or a zero risk kind of scenario. If you take some clients on during the weekends, you haven't risked your full-time job. So you should be all good. Even if it doesn't work out, you're good. Your bills are paid. You're not having to get desperate in terms of trying to get clients, because a lot of clients out there are just not good clients and you want to stay away from them. So I would say approach it that way. Or if you have a job where it's flexible, tell them, hey, I want to work 4 days a week instead of the 5. I'll put in more hours. You'll still get the 40 hours out of me, but Friday I want all to myself. And on Friday is where you build up all those side clients and you see what you can do in terms of building your own firm. All right. And then if it's successful, you start building and building and building. And then maybe you go down to 3 days a week with the regular job. And now 2 days a week, you're doing your own thing. So in that way, you can test the waters and see what kind of juice is out there for you and pursue it that way. I'm not crazy about scenarios where someone just says, oh, I just quit my job at Google and now I'm just developing an app that probably no one's ever going to use or care about. It's kind of sad to see that. And you could have learned that nobody wanted to see that app by doing it on the side, doing it on the weekends, hustling a little bit and trying to get it out there that way. At least you still have your job intact and you haven't put yourself in a precarious situation from a cash flow perspective. All right. So with that, it looks like those are all the questions for now. Again, guys, thank you. Like the video, especially if you stuck around this long. Subscribe to the channel. And there's still one of you that hasn't liked the video. There's 8 concurrent viewers, 7 likes. So whoever's out there, smash that like button. It's free. It's not going to bite you. All right. Well, hopefully this was helpful. Thanks for watching.